Crocs reported earnings last month and the stock tumbled 20%. Revenue guidance disappointed investors and shares are now down 38% from their 52-week high. At the latest price, Crocs now has a market value of $6.1 billion. There's $186 million of cash on the balance sheet and $1.4 billion of debt, so the enterprise value is $7.3 billion. Meanwhile, revenue over the last 12 months comes to $4.1 billion with $835 million of net income and $940 million of free cash flow. So Crocs stock is now valued at only 7.3 times earnings and under 8 times free cash flow. There's one key reason why investors are worried about Crocs, and it boils down to growth. Total revenue is up just 3% on a trailing 12-month basis. North American sales continue to slow down, but the biggest culprit is the company's Hey Dude brand, which it bought back in 2021 for $2.5 billion. While Crocs revenue should grow 8% this year, Hey Dude is set for a 15% decline. That follows a 17% drop in the third quarter. So based on what management predicted at the beginning of the year, the Crocs brand has slightly outperformed, while the Hey Dude brand has been a massive disappointment. Objectively, the acquisition of Hey Dude looks like a mistake. The brand hasn't gained traction among consumers or shown much promise. Even so, management insists they're still confident in the brand. They continue to iterate on new styles and try different marketing strategies. They recently opened a TikTok shop and onboarded US actress Sydney Sweeney as a director of Dude. But 2025 is unlikely to see much of a rebound. Management has called it a year of investment where they hope to try and stabilize the brand. However, even without Hey Dude, Crocs stock doesn't look all that expensive, especially when you consider how profitable the company is. Free cash flow margins this year are about 23% and the 5-year average is 19%. So Crocs only needs to show modest growth for the stock to provide strong returns. For example, let's assume Crocs can deliver just 3% revenue growth for the next 10 years and 18% free cash flow margins. In that scenario, Crocs would generate almost $9 billion of free cash flow. That's significantly more than the current market cap. A simple discounted cash flow model that assumes a 10% discount rate and a 2.5% terminal rate then puts the annualized return around 14.8%. The risk for investors is that Hey Dude never turns around and the Crocs brand starts to fade. Investors have been anticipating such a scenario for the last 20 years, but the brand continues to stick around. A more likely scenario is that Crocs continues to grow modestly, helped by international markets, and management finally finds a way to stabilize Hey Dude. When that happens, Crocs stock should be sharply higher from here. But these are my personal opinions, not financial advice, and I may buy Crocs stock in the near future. For more investing videos, make sure to visit my website at 3minutebreakdowns.com. Thank you for watching.